Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest and author of the Options Playbook. All right, in the heart of earnings season, we're going to do an earnings play, and I kind of threatened that I might do this next week. We're going to look at Amazon. There's been a lot of earnings that have came out this week. A lot of the mega cap tech stocks or FANG stocks are going to be announcing this week. We have Google tonight. We have Apple at the end of the week. We're going to focus on Amazon. We're going to look at the retail space. Amazon is much more than just a retail company, but with that said, the one thing I really like about Amazon is they usually announce earnings on a Thursday after the close. At least for many, many years, as far as I can remember, they always announce on a Thursday. That means that as far as option pricing is concerned, you have one day for that Friday expiration option contract to live. All of the volatility, all of the time premium has to come out of those option contracts in that one trading day. So it always makes it an interesting trade just from an option pricing dynamic. And that's what the stock play of the day is all about. We're just trying to learn what are strategies that are matching the marketplace, not necessarily trying to make a recommendation on an underlying or anything that goes along with that recommendation process. We're trying to learn. And the biggest thing, when we have high volatility, we have a fairly pricey option contract. Amazon was really interesting when it was a $2,000 stock. Now they've done their 20-for-1 split, and it's trading right around 120 right now. Still makes it an interesting trade. Just if you were, you would do a little bit more contracts, I guess. Not quite as much risk if you just do it on a one contract basis, but that's what we're going to be focusing on today. But before we get there, let's take a little peek at the marketplace and talk about last week's trade. So I am highlighting my VIX watch list, and we've seen the VIX actually just hang out around the 30 level forever. And right now we actually see it. We've had a good solid bull run in not only the NASDAQ, but also in the S&P 500 index. Even the Russell 2000 index has done well. As a matter of fact, the Russell 2000 index today is actually leading the markets higher. That's usually a good sign for the markets when you're seeing the small caps leading the way. NASDAQ is up 1.8%, and we got the SPX, the large caps, at 1.27%. VIXs came off. It's really been stubbornly above that 30% range. And I kind of expect it to hang out a little bit higher here until we get through the elections on November 8th. Good news for the market, if you can say there are good news. Well, the run up recently, if you look at the S&P 500 index, kind of see the run up. We're going to look at the NASDAQ here shortly too. The good news is that most of the time after a midterm election, going all the way back to 1950, most of the markets do well after midterm elections. They call it just the term election year usually means that the markets will do well. Now, there's a lot of headwinds, possible recession, geopolitical concerns, And one of the things that you always want to be aware of during an election too is that uh, the market likes when there is animosity in the government. They don't like when one party has more power than the other. So right now, it looks like it may be a divided government. Democrats are winning in the Senate so far from polls, and Republicans are looking good in the House. As long as that holds true, that's usually a good sign for the marketplace. When one political party receives too much power, markets get nervous about policy change, and so that's just something to keep in mind. If the things stay the way they are, the way that it's looking right now, the markets will usually look at that as we're removing one of the uncertain things. Policy changes are going to be a little bit harder to make. And because of that, it's easier for companies to kind of make plans and forecast going out in time. Okay. So I guess you got to highlight some good news. There's a lot of bad news out there. Inflation just isn't waning. We obviously, the European economies are weak relative to the US economy. And because of that, we're kind of seeing the Russell 2000 do fairly well. The dollar is extremely strong, which is hurting the European economies above and beyond. We're getting into the winter months. Obviously, the Ukraine Russia situation is not going away. All right, enough said. We did make it through September and October. We're almost there on the October month. There's still have, like I said, a lot of volatility that could be, and we're seeing the VIX at those levels. I expect the VIX to stay high up and going all the way to that election date. But let's look at last week's trade. Okay, paper trade, I should say. Everything that we do here on the stock play of the day is a paper trade. We're not meant to be a recommendation. But that was on the 18th. We always tape around noon. We can't control the time when we tape a stock play of the day, so we're always using live markets. And so this is a 15-minute chart kicking off at noon Eastern time. We see where the market was at, right around 271. A lot of chop in the market. This is all day Wednesday, decent up day, still not really going anywhere. And then now we've had a real strong move all the way up to the 283 level. So since last week, this would be a good thing. There's no real reason to ever get out of the trade because the market was still hanging. We bought an out-of-the-money option contract, and usually if I'm going to look at an out-of-the-money option contract, I'm going to err to the side of buying too much time as opposed to not enough. You can always sell and try to capture some of that time. But specifically on out-of-the-money options, I talked last week about why we'd like to go out further in time instead of speculate on a shorter term move. And here's the trade that we looked at. So right now we have the QQQs. It's up 510, up 1.8%, 283.59. We went out to the November 18th expiration. So we still have 24 days remaining. We bought the 290 strike call. The 290 strike call was trading right around $4 last week. I'm rounding off a little bit, but like I said, there are live markets. Not quite sure exactly where we might have filled, but the QQQ has extremely liquid options. It's one of the most heavily traded option contracts here at Ally Invest. And the market ran up solid. So we almost doubled in price. Well, not quite, I guess. And look at how tight the market is. Here's our option contract, 730 by 732. So we're looking at a 2 or 3 cent spread. So obviously you sell it, get out. There's nothing wrong with that. Your forecast was correct. We got a big move right away, which is what you want when you're buying out of the money options. The longer it takes, the more time decay can set in and the more it can hurt your position. So if I'm buying out of the money options, not only do I want the move to be big, I want it to happen as fast as it can. So I always like to give you an alternative. Ideally, you would just buy this, went up, doubled, get out, right? You might stay the course a little bit, see what happens going into the end of the week. But what was your forecast? What was your goal? Are you truly hedging all the way out to the end of November? Well, maybe you just stay in the trade. If this is a fear of missing out, because you do think you're going to have a solid earnings season, or maybe the retail customer can uh, keep this marketplace rocking and rolling going into the holiday season. That's one other little bright spot, that the consumer is still fairly strong. Waning a little bit, but fairly strong. But here's an alternative, right? We rounded off and said we paid $4 for this trade. It's trading for $7.25. How about we take our money off the table? How could we take the money off the table? Brian, we just did one contract. Right. Well, so if you sell one contract, you can't take a profit because you're just getting out. If you did 5 contracts, well, yeah, you could sell 2 or 3 of them. So here's one way that we can do this on our one contract basis, is actually take this long call and roll into a long call spread, otherwise known as a bull call spread. So we're at 290. If we go out and sell the let's go 295. Let's give us 5 points more of upside. So we can take our initial investment off the table. We paid $4. We sell the 295. We'll get a potential $5 from this trade. Now, you're going to be in this a little bit more long term, and we've talked about long call spreads. You want to be closer to the expiration and have your forecast correct. So now we've gone from wanting it to happen in a hurry to, all right, it's okay if you slow down a little bit. We still want you to go up, but we're going to be more profitable if we're closer to the expiration date. Why is that? Well, we're going to be selling this option contract, bringing in $5, and let's call it 35 cents. Okay, yeah, that's the ask. We'll call it 30 cents, $5.30. We paid $4 for the initial call option. That means we're going to take a profit of $1.30, put that in our pocket, and we're going to just watch and hope that the market rally continues going into the end of November. The expiration date is highlighted here at November 18th. By doing this, I still have the potential to make 5 points, which is the width between the spread, 295 minus 290. And now I'm not as worried about time decay. As a matter of fact, I need time decay. This option contract that we sold wants the market to stay where it's at or go down. And this one that we bought still wants the market to go up. So they're going to fight each other until some of this time value whittles away. So we've totally changed what we want the market to do, but we've taken some of the coin off the table, still made the trade profitable, and we still have some upside potential on the trade. So it's always interesting. I think it's better to have a plan, but we did actually get it. I might adjust my plan in this situation, and in that we got the move to happen so quickly that, okay, there's still a lot of time premium in these option contracts. How can I take advantage of that? But most of the time, if I'm buying this out of the money option contract, I get the move that I want. I'm just going to sell it and close out that position. Okay. So this would be our final position. Ignore where the price is at right now because that doesn't matter. We paid $4 for the option contract. Bottom line is, if we did adjust our trade, we'd be long one of the November 290 calls, sell to close or sell to open a brand new November 18th 295 call. Pocket about $1. What did I say? $1.50? No, $1.30. Pocket $1.30 and hope that the market goes up above 295. If you didn't want to pocket it, you could actually give yourself even a little more upside. If you go all the way up to the 300 level, you're almost bringing in what we paid for it. 287 or 387, 390 on the ask right now. We paid $4 for the trade. So if you just wanted to take the money off the table and give yourself a little bit more upside, there's a lot of flexibility in the Qs because there's a lot of liquidity in the option contracts, which is very nice. Option traders don't always get that benefit. And on top of it, there are a lot of different strike prices, only because this underlying can support 1 point strike prices on a $290 stock, or wherever we're at right now, $283 stock. All right, let's get into today's trade. And if you have any questions, I'll just say it right now. Go over to the chat box. You put them in the chat box. I won't look at them right away, but we'll come back and address these questions on the QQQ. And today we're going to look at Amazon. We're going to be chasing butterflies in the Amazon, is what we titled the show today. And it has the butterfly trade, which is a little bit more advanced here for the stock play of the day, is chosen. Well, I should say I selected the butterfly trade only because Amazon is announcing on Thursday and the options only have 1 day to live. When you do a butterfly, let's run to the options playbook and see what a butterfly is. We're gonna flip a coin. You could be bearish, you could be bullish. We're gonna go a little bit bullish. We're gonna hope that the retail customer is gonna stay strong and hopefully we'll get some decent numbers. But that's not really what the show's all about. So we're gonna do the long call butterfly. We're gonna go about the expected move out of the money. And even more so than long call spreads, butterflies really need time decay. If you're correct on your forecast, what you do here, you have strike A that you bought inside the options playbook. You have strike B that you're selling, but you're going to sell 2 of those option contracts. So if you're correct on your forecast and it goes right to strike B, which you see here in the profit and loss graph, well, you're not going to get the big benefit until that strike B whittles away. And that's because of time value. You're going to have 2 at-the-money option contracts if you're correct on your forecast, and you have to buy and close that position in order to get out of the butterfly. So you want these to be as low as possible. You want to pay next to nothing for at-the-money option contracts, and that's hard to accomplish. Hence the reason we're looking at a butterfly that will have a huge rate of time decay on our option contracts if we're correct on our forecast. Now, we're going to do a directional butterfly, implying that the stock is somewhere down here below the most expensive option that we're buying, strike A. So the stock is somewhere down here, and we're hoping that it will move and it will land within a range. Increased implied volatility lets us widen that range a little bit and still get the butterfly done for a fairly inexpensive cost. All right, so let's go and look at that trade. All right, here's Amazon. Right now it's up almost 1%, up 95 cents at 120.75. So if we're doing anything around earnings, which I do need to emphasize that earnings are a very speculative trade. Part of the reason why I like to do trades around earnings is it's a real interesting pricing dynamic. And that's the one thing you need to learn if you're going to be trading options is how these options will react to swings in implied volatility as time decays, et cetera, et cetera. So when you're buying stocks, there is no time component in the stock price. Maybe a small argument about cost to carry, but with that said, there's really no time component in it. But in the options, they're all made up of time. It's a contract. It has an expiration date. So it's all about time, and it's all about how you're going to manage that time premium, especially if you're speculating on a short-term trade like around earnings. Okay, so I start by looking at if I bought the most at the money. Well, now it's 121. When I first looked at this, 120 was at the money. But the most at the money nearest term expiration. So we're going to go out to the October 28th expiration, which is this Friday. So Amazon announces on Thursday. You have that Friday expiration. 120 where we're at. Let's add, if we bought that call and we bought that put, we're looking at almost $9, just a little less. We'll call it $8.75. So if we take 121 plus 870, let's call it $9. That would be the 130 level. So we're going to target the 130 level. And you'll notice here in the Ally Invest option chains, I have the calls on the left-hand side, the put on the right-hand side. We have these little check boxes, and we make it very easy to enter a multiple leg strategy in that. We're going to buy the 125. So we want the market to at least get to 125, do at least half of the expected move. We're going to target that expected move area, which is basically the long straddle. And that's about an 8.5% move is what the market is looking for. So if we're targeting that, we'd like the stock to go to somewhere around the 130 area. And then we got to protect ourselves. So we're going to come on out and we're going to buy the 135. And that is just to make sure that the stock just doesn't take off and limit our risk to what we paid for the butterfly. So we're going to do this on a 1 by 2 by 1 basis, which we highlight here inside, oops, wrong one. Inside the options playbook, we're going to sell 2 call options, buy 1, sell 2, buy 1, okay? So let's go back to the trading tab, scroll down to the options strategy workbench, and you see here to complete the butterfly, we're going to enter this all as one trade. We're going to buy the October 28th 125 strike, sell 2 of the 130 strike calls, and buy 1 of the 135. We're right now looking at a net debit of 78 cents to the account. And well, that would be a solid fill. Never guarantee a midpoint fill. Don't forget you got to put commissions in. You're still paying commissions on the option contract, so that is important to note. But if we do this on a 1 by 2 by 1 basis, we send this to the trading floor and we can fill it at the midpoint of 78 cents. That means this entire gaggle of options is going to cost you $75 plus commission. What you want is the market to stay somewhere between 125 and 135 by that Friday expiration. And also realize that it's going to take some time for this center strike to whittle away. We're only bringing in $1 here, which is going to be, we're trading at about 100% implied volatility. Well, on that option contract is 86. The more at the money is 91. So we expect implied volatility to come in. It's going to take a little bit for that to whittle away. So if we hit the 130 strike right away on the open, be prepared that you might not get as big of a reward as you think. If I'm paying 75 cents for this and I can sell it for 150 or I can sell it for $2 and it's sitting right at 130 on the open, well, I'm going to want to do that. Just want to get out of the trade. I don't want to have the risk of an entire day's worth of trading in Amazon. So don't expect to get the maximum on this trade, which is $5, which is the difference between the strikes. If I'm doing this trade, I want to have a realistic expectation, and the only way to receive the maximum is if the stock goes out right at 130, right at that expiration date. Okay, so we'll put it in the right rail, and then we're going to look at the profit and loss calculator. All right, so here you go. We are buying to open the October 28th expiration, 125 strike call. Same time selling 2 of that same expiration, 130 strike call, going 5 points more out of the money, and buying our protection, buying that same expiration, 135 strike call. Hoping to get this done at let's say 75 cents, just to make life simple. That means $75 for every 1 by 2 by 1 that we execute plus commission. And that will be our max risk on the trade. Max upside is the width between the strikes, which is $5 minus the 75 cents or $4.25. But honestly, if you receive that $4.25, you should probably also receive this stupid award. Why is that? Because you should have got out earlier. I'm trying to get a home run, hoping that right at the expiration date, it's going to stop right at 130. I don't like that. If you can make $3, $4 and you don't do it, and you take that risk to try to receive those last couple of quarters, it just doesn't really make sense to me, right? You want to take it off, put the trade on, it moves in your direction, take the trade off, and move on. It's a 100% speculative trade here. All right, so I'm going to close the right rail. I'm going to scroll down. If you have any questions, you can go ahead and put them in the chat box. We've got a few minutes here left here on the stock play of the day. But I'm going to take a quick peek at the profit and loss graph inside the option chains here at Ally Invest. And this highlights, okay, the white line is the stock. This is where it's at. The expected move is about 130. So you're going from 121 to right around $9, looking for it to get to somewhere right around that 130 level. If that does happen, you see that if it happens right now with implied volatilities up around that 90% level, there's not a lot of profit. But as time decays, we're going to put this down to 0, and expiration approaches and implied volatilities come in, now the profit and loss graph looks a lot more exciting. So with high volatility, still a few days left till that expiration date, it's not as enticing as if you'd look at this trade right at the expiration. Now, it is Tuesday. They're announcing on Thursday. We tape the stock play of the day on Tuesday. I might wait until Thursday to do this type of trade. I don't mind putting it on right now, but ideally, if you're really just playing the earnings event, you might want to wait until Thursday to put it on, get the news, take it off on Friday. So I just want to make that very clear. We tape the stock play of the day on Tuesday, so guess what? We're going to use the prices on Tuesday. All right. Any questions? All right, here we go. We got a hi all, and we got a response. Nice, just nice little conversation in there. If you have any questions, this will be your last chance in order to do this, in order to answer any of the questions that you may have. All right, and if not, well, that's going to be it for this edition of the Stock Play of the Day. Please click subscribe, ring the bell, give us a thumbs up if you like this content, and we'll see you this coming up Tuesday. We'll see how the big week of earnings plays out, and we'll see you on this coming up Tuesday for the next Stock Play of the Day. Thanks for coming, everyone.